It's 3 o'clock in the morning. You're lying in bed, staring at the ceiling, doing math you never planned on doing tonight. Not fun math. Not how much will I save on this vacation math. This is heavy math, life math. There's a house involved. There's a mortgage involved. And there's a number that refuses to leave your head. Maybe it's $300,000. Maybe it's $500,000. Every month, you send a payment so large it almost feels unreal. And a painful part of that payment doesn't even make a dent in what you owe. It just disappears into interest. Meanwhile, your college friend won't stop posting screenshots of their index fund returns. Up 18% this year. Compounding is insane. Money working while I sleep. And now you're stuck with the question that quietly drives people crazy. Should I use my extra money to pay off my mortgage or invest it? Tonight, we're not dodging that question. We're not giving vague advice. We're not saying it depends and moving on. We're going to walk through real numbers, real trade-offs, and a framework that actually respects how humans think and feel about money. By the end, you'll understand why the obvious answer is often wrong, why math alone can mislead you, and how to build what I call a freedom fund. Let's start with a scenario that looks a lot like real life. You buy a home with a 30-year mortgage. Loan amount, $500,000 interest rate, 7%. Term, 30 years. Your monthly payment, principal plus interest, comes out to roughly $3,327. That's before property taxes, insurance, HOA fees, just the mortgage. You make these payments for a year. Life goes on. And then something good happens. You get promoted, more responsibility, more stress, and $1,000 extra per month hitting your bank account. And now the real decision begins. Do you throw that $1,000 at your mortgage or invest it in the stock market? This single choice, repeated every month, quietly shapes your financial future for decades. Let's start with the strategy everyone loves to talk about. You decide. Starting in month 13, you invest $1,000 per month. You choose a low-cost total market index fund. You stay disciplined and automate everything. Now we need an expected return. Historically, the stock market has averaged about 10% per year over long periods. To stay conservative and realistic, let's use 9% annually to account for fees, taxes, and bad years. But we'll make this even more realistic. Your income doesn't stay flat forever. So each year, you increase your monthly investment by 3%, matching raises and inflation. This is sometimes called a step-up investment strategy. Now run that plan for 29 years, the remaining life of the mortgage. Here's the result. Your investment account grows to approximately $1.83 million. Let that sink in. That's retirement money, financial independence money, the kind of number that changes how you live. At first glance, this feels like a no-brainer. Why would anyone choose a mortgage prepayment over this? But we're not done yet, because this comparison is missing something huge. Most people don't truly understand how mortgages work. Let's break the illusion. Imagine your $500,000 mortgage is 10 blocks, each worth $50,000. You make payments for a full year. You send the bank roughly $39,000 total. Logically, you might think, cool, I knocked out almost one whole block. Wrong. After 1 year, your balance isn't $450,000. It's closer to $496,000. You only paid down about $4,000 of principal. So where did the other $35,000 go? Straight to interest. This is amortization, and it's brutal in the early years. Let's look at real numbers from month 1. Payment, $3,327 interest, $2,917. Principal, $410. That's 88% interest. Even in month 12, interest is still nearly $2,900. Principal barely cracks $430. 5 years in, you're still paying over $2,700 in interest every month. It takes more than 20 years before your payment becomes mostly principal. For 2 decades, the bank is winning. This matters a lot when we talk about extra payments. Now let's flip the strategy. Instead of investing the extra $1,000, you apply it directly to principal. Start in month 13. Increase it 3% every year, same as before. Here's the key difference. Every dollar of prepayment goes 100% to principal. No interest, no dilution, no delay. And the results are dramatic. Your 30-year mortgage is paid off in just over 16 years. You eliminate nearly 14 years of payments. Total interest paid drops from about $698,000 to $318,000. That's a savings of roughly $380,000 in interest. Sounds like a huge win, right? But we need to be honest. You didn't save $380,000 for free. Over those years, your extra payments added up to about $238,000. So your net benefit is closer to $142,000. Good money, but nowhere near $1.83 million. If we stopped here, investing would look like the clear winner. But again, we're still missing something. When you pay off your mortgage early, you don't freeze time. You don't stop living. You don't stop investing. You suddenly free up cash flow. Once the mortgage is gone, you now have the original $3,327 payment, plus the extra $1,000, totaling $4,327 per month, and you still have about 14 years left until the original 30-year mark. So what if you invest that money? When you do, something interesting happens. That $4,327 invested monthly for the remaining years grows to about $1.18 million. Add the $142,000 interest savings, and your total ends up around $1.32 million. Now the gap narrows. Investing only $1.83 million. Prepay, then invest $1.32 million. Investing still wins, but not by as much as people assume. And now, we reach the most misunderstood risk of all. Markets don't give you smooth returns. They give you chaos. You might average 9% over 30 years, but the order of returns matters. Investing right before a crash is very different from investing right after one. Same contributions, same market, wildly different outcomes. This is called sequence of returns risk. Mortgage prepayment doesn't have it. When you prepay a 7% mortgage, you earn a guaranteed 7%. Zero volatility, zero downside, zero uncertainty. That's rare, and it's tax-free. You don't pay capital gains on interest you never paid. This is why the decision isn't as simple as stocks beat mortgages. So what's the real answer? You don't choose one. You build both. The F-squared rule stands for Freedom Fund. Part of your money builds wealth. Part of it buys peace. You split the extra cash in a way that fits your psychology, not just a spreadsheet. Common splits. 60% investing /40%. Prepaying 50/50 balanced age-based adjustments. Because money is not just math. It's sleep. It's stress. It's how trapped or free you feel in your own life. Now that you understand the trade-offs, let's bring everything together. We've seen 3 realities. Investing early builds the most wealth. Mortgage prepayment delivers certainty and peace. Math alone doesn't capture how humans experience money. So let's test the strategy that tries to respect all 3. The 50/50 Freedom Fund in action. You take your extra $1,000 per month and split it. $500 goes into investments. $500 goes toward mortgage prepayment. Both increase 3% per year. Same assumptions, same discipline. Mortgage side results. Mortgage paid off in about 21 years, not 30. Interest saved, roughly $198,000. Extra payments made, about $119,000. Net interest benefit, $79,000. You don't win the math battle here, but you win something else. You get your house 9 years early. That means 9 years of no mortgage stress, lower required income, more flexibility in life decisions, and that matters more than spreadsheets admit. Investment side results. Your $500 monthly investment, stepping up annually, grows to about $842,000 over the remaining 29 years. But remember, once the mortgage is gone, your cash flow explodes. At payoff, you now invest the full mortgage payment, plus your existing $500, totaling about $3,827 per month. You do that for the remaining years. That adds another $462,000. Now let's add it all together. Investments before payoff, $842,000. Investments after payoff, $462,000. Net interest benefit, $79,000. Total, approximately $1.38 million. Is it the highest number possible? No. Is it strong, balanced, and emotionally sustainable? Absolutely. When prepaying clearly wins, there are situations where paying down debt should be your top priority. 1. High-interest debt. If you're carrying credit cards at 15 to 25%, personal loans above 10%, stop everything else. You are not consistently beating that in the market. Pay it off. Period. 2. Nearing retirement. Within 10 years of retirement, a paid-off home slashes your required income, reduces portfolio withdrawal pressure, makes market volatility less dangerous. Debt is risk in disguise. 3. Job or industry. Uncertainty. If income feels shaky, lower obligations equals higher resilience. You can't pay a mortgage with unrealized gains. 4. Mental health and stress. If debt keeps you up at night, paying it off isn't emotional weakness. It's intelligent self-management. Peace of mind has a return, just not one Wall Street tracks. When investing clearly wins, now the other side. 1. Very low mortgage rates. If you locked in 3% to 3.5% during 2020 to 2021, that's borderline free money after inflation. Invest aggressively. 2. No emergency fund. If you don't have 6 to 12 months of expenses in cash, do not lock money into home equity yet. Liquidity comes first. 3. Missing retirement matches. Not maxing employer 401. Match. You're turning down guaranteed returns. Fix that before prepaying anything. 4. Youth plus time. In your 20s or early 30s, time is your unfair advantage. Compounding rewards early action, not perfect timing. Here's a framework that actually works. Above 8% arrow, prioritize prepayment. Below 4% arrow, prioritize investing. Between 4% to 8%, arrow, split the difference. That's where most people are today. And that's exactly where the Freedom Fund shines. Why the best strategy often fails. Here's the uncomfortable truth. The optimal mathematical strategy often fails in real life. Why? Because it ignores behavior. A strategy that maximizes wealth but increases stress or causes panic selling or leads to burnout is a bad strategy. Money is not just numbers, it's narrative. 2 people, same house, different stories. Walk into the same home. One person thinks, this is success, stability, I made it. Another thinks, this is a 30-year obligation I can't escape. Same mortgage, same numbers, different meanings, and meaning shapes behavior. The real point of the Freedom Fund. The Freedom Fund isn't just money, it's freedom from anxiety, freedom from forced decisions, freedom to walk away when life changes. Some people feel trapped by debt. Others feel trapped by illiquidity. Neither is wrong. They're optimizing for different freedoms. Design the life first, then do the math. Here's the most important part of this entire discussion. Before calculators, before spreadsheets, before strategies, ask yourself, what does financial freedom actually mean to me? Not what YouTube says, not what your parents believe, not what your friends post online. You. Once you know that, the math becomes easy. Final thought. There is no single right answer. There is only an informed choice made intentionally aligned with your values, whether you invest everything, whether you pay off the house fast, or whether you split the difference. If you understand the trade-offs and choose deliberately, you're already ahead of most people. And yes, even after all this, I still ask myself what to do with my own extra $1,000. That's not a flaw. That's personal finance being personal.